Very good day, friends. In this video, we are going to pick up the topic on incomes exempt. That means incomes which do not form part of the total income. We will look at the exemption under section 10(1) in respect of agricultural income, the exemption in respect of newly established units in SEZ under section 10AA, certain other exemptions under section 10, and treatment of expenditure incurred in relation to exempt income, which is provided under section 14A. So when we talk about an exemption, when we talk about an income exempt from tax, it basically means that such income doesn't enter the computation mechanism. It is not included in computing the total income in the first place. Whereas when we talk about a deduction, it means that it is an amount which is to be reduced or to be deducted from the income in order to arrive at the total income. So while computing the income, we allow for a deduction. While on the other hand, if we are talking about an exemption, then the exempt income doesn't enter the computation mechanism in the first place. We will now discuss the provisions regarding exemption under section 10(1) in respect of agricultural income, which is defined under section 21A. What is agricultural income? Following incomes from land which is situated in India and is used for agricultural purposes is classified as agricultural income and is therefore exempt. So land should be situated in India and it should be used for agricultural purposes. And there are these categories of items of income that are classified as agricultural income, which is given in the table. We will look at these items one by one. Number one, rent or revenue derived from such land. Which land? Land which is situated in India and is used for agricultural purposes. So rent or revenue derived from such land is agricultural income, right? For example, there is a land which is used for cultivating maize, which is owned by A and which is rented out to B. So rent which is derived by A, rent which is earned by A is agricultural income and is exempt from tax. We may note that ownership of land is not necessary. So if, for example, B, who doesn't own the land, he further lets it out to C. So rent which is received by B is also agricultural income and is exempt from tax. If there is a transfer of land which is an agricultural land, but it is an urban agricultural land, that means it is situated in an urban area. That means it's not situated in an rural area. Then it is not classified as agricultural income and it is taxable. It is taxable as capital gains. We will deal with this in detail in the video on capital gain. So the first item is rent or revenue derived from such land. It is exempt. Second item, the income derived from such land by agriculture is exempt. So if agricultural operations are carried on, if, for example, there are sugarcane fields, then income derived from those agricultural operations, right, whereby sugarcane is produced, is agricultural income and is exempt. Consequently, income which doesn't involve agricultural operations is not exempt. For example, if land is used, though it is agricultural land, but it is used for breeding of livestock, so income from such breeding of livestock, since it is not arising out of agricultural operations, will not be exempt. Now there could be income from saplings or seedlings which are grown in a nursery, right? In such cases, it may not be necessary that operations are carried out on land, right? Saplings or seedlings may be grown in pots. And therefore, the question is whether such income is exempt as agricultural income. So in such case, a specific exemption has been provided where such income is deemed to be agricultural income and is therefore also exempt. Number 3, so income derived from such land by the performance of any process. If a process is performed, right? Which process? Which is ordinarily employed to render the produce fit to be taken to the market, right? Which is ordinarily employed, right? Which is ordinarily employed to render the produce fit so that it can be taken to the market. Income from the performance of such process is also exempt as agricultural income. But the condition is that The process should be the process which is ordinarily employed to render the produce fit to be taken to the market, and it's called a compulsory process. Compulsory process means that without such process, it will be next to impossible for the cultivator to take the produce to the market, to make it fit to be taken to the market. That's why such process is required to be performed, right? Number 4 is also similar to number 3, and it basically says that income derived from such land by the sale of the produce in respect of which only compulsory process has been performed is exempt as agricultural income. So if we combine items number 3 and 4, what we see is that income which arises on account of performance of a process which is a compulsory process, right? And income which arises from the sale of such produce by the sale of such produce in the market is agricultural income, and it is exempt. But the condition is that the process should be limited to a compulsory process. But in a case a further process is performed which is in addition to the compulsory process, then taxable business income will also arise. For example, if sugarcane is processed to convert it to sugar and the sugar is then taken to the market and sold, so a composite income will arise. Composite income will arise. Composite income, it means it will be a combination of exempt income, which is agricultural income, and taxable income, which is business income. So the composite income will need to be computed, and then it will need to be apportioned. It will need to be apportioned between exempt income and taxable income. Number 5. So income derived from any building which is in the nature of a dwelling house or a storehouse or other outbuilding is also exempt if such building is on the agricultural land or in the immediate vicinity of such agricultural land. Income from such building is also exempt, and the condition is that either the land should not be situated in an urban area. That means either the land should be situated in a rural area, or it should be assessed to land revenue in India or be subject to a local rate. So for example, if there is a agricultural land and there is a building in the immediate vicinity in the nature of, say, a storehouse where the agricultural produce is stored before it is sold in the market, and if such building is situated in a rural area, then the income arising from such building is exempt. Or if it is situated in an urban area but it is assessed to land revenue in India or is subject to a local rate, then also the income is exempt from tax. But income from such building or land which is used for any purpose which is other than agriculture is not agricultural income and is thus not exempt, right? So the land as well as the building should be used for agricultural purposes. If there is a storehouse which is on the land or in the immediate vicinity of the land, but it is not used for agricultural purpose, it has got no connection whatsoever. For example, it is rented out to someone for his residence, then merely because it is in the immediate vicinity of agricultural land, income from such building will not be exempt, it will be taxable. Income from agricultural land situated outside India is not exempt because agricultural land should be situated in India. Or income from land which is though situated in India but is not used for agriculture is also not exempt under section 10(1). Now, as we noted above, there could be a situation where composite income is arising and therefore it then needs to be apportioned between exempt and taxable income. For apportionment of such composite income, there is a general rule and there are certain special rules in certain specific categories of income. First, we will talk about general rule, and this is provided under Rule 7. Rule 7 prescribes the method to apportion composite income into agricultural income and business income. And general rule applies where special rules do not apply. We will talk about special rules after we have discussed the general rule. So how do we apportion the composite income as per the general rule? So if there is a sale of agricultural produce and therefore income is arising out of that, if there is no processing which has been done, right? If the agricultural produce is sold in its raw state, right, then it is classified as pure agricultural income and it is wholly exempt under section 10(1). Similarly, as we noted above, if only compulsory process has been performed, even then it is exempt wholly and it is classified as pure agricultural income. But problem arises when an extra processing has been done. When an extra processing has been done, for example, sugarcane is converted into sugar. In that case, composite income arises, and then it needs to be split, and we need to determine the amount of taxable business income and exempt agricultural income. And how do we do that? So, for determining the amount of business income, we first figure out the sale proceeds, the sale proceeds in the market. We deduct what? We deduct the market value or the sale receipts of agricultural produce which is utilized as a raw material, right? So if sugarcane is converted into sugar, then we deduct the market value or sale receipts basically of the sugarcane which is utilized as raw material to produce sugar. And then there will be certain manufacturing expenses, we reduce that. And this brings us to the amount of taxable business income which is taxable under the head PGBP, profits and gains of business or profession. Now, how do we determine the amount of agricultural income which is exempt? So as we saw, we are supposed to reduce the market value or sale receipts of agricultural produce which is used as a raw material, in further processing. So the market value or sale proceeds of such raw material which is the agricultural produce, we take this first, and then we would have incurred certain cultivation expenses in cultivating the agricultural produce, that is reduced, and the balance is agricultural income which is exempt under section 10(1). Now there are certain special rules which are provided under 7A, 7B and 8 which deal with certain categories of income where a standard percentage is prescribed in terms of apportionment. So first is rule 7A which deals with income from manufacture of rubber. So where there is a sale of centrifuge latex or Cenex or latex based crepes or brown crepes or technically specified block rubbers manufactured or processed from field latex or coagulum obtained from rubber plants, right? Sale of processed produced which is obtained from rubber plants, and rubber plants are grown by the seller in India. In that case, since there is a processing of rubber and that processed produce is sold, composite income arises and there is a standard percentage. So there is a presumptive taxable income which is determined as per rule 7A. And 35% is considered as taxable business income while the balance of 65% is exempt as agricultural income. Income from manufacture of coffee is covered by rule 7B, and there are two cases. In the first case, there is a sale of coffee which is grown and cured by the seller in India. In such case, taxable business income is 25% and the balance is exempt agricultural income of 75%. In a case where the coffee is not only grown and cured, but some further processing is done in terms of roasting and grinding. The coffee is roasted and grounded by the seller in India with or without mixing chicory or other flavoring ingredients. Then, since slightly further processing is done, then the portion of taxable business income rises from 25% to 40%, and consequently the exempt portion is reduced from 75% to 60%. Rule 8 deals with a case where income is from manufacture of tea, and where the tea is sold and such tea has been grown and manufactured by the seller in India. In such case, 40% is taxable business income and the balance 60% is exempt agricultural income. So if the income is from manufacture of rubber or manufacture of coffee or manufacture of tea, special rules apply, and therefore we need to follow these percentages for apportionment. We need not resort to the general rule. However, in all other cases where these special rules are not applicable, we need to follow the general rule under rule 7 and make the apportionment of the composite income. Now the agricultural income is exempt from tax. That means tax is not supposed to be levied on agricultural income. However, the agricultural income is partially integrated with non-agricultural income for levy of tax. How this is done? Let's see. Where the assessee has the agricultural income in the previous year, in addition to total income, right? So the assessee has taxable income as well as exempt agricultural income. Then the agricultural income is taken into account. That means it is integrated with the total income in the prescribed manner. For what? Only for the purpose of charging income tax in respect of the total income. Okay, tax is not charged on the agricultural income, but for charging tax on the total income, which is the taxable income, agricultural income is supposed to be integrated in the prescribed manner. And this method applies only to an individual HUF, AOP, BOI or artificial juridical person. It doesn't apply to any other person, for example, a company. For this partial integration, two conditions need to be satisfied. If these conditions are not satisfied, this partial integration process is not followed. Number one, we determine the net agricultural income in a specified manner, which is outside the scope of our syllabus. So we determine the net agricultural income and it should be greater than 5,000. Net agricultural income should be greater than 5,000 and the total income, which is the non-agricultural income or the taxable income, should be greater than the basic exemption limit, which could be either 2.5 lakh or 3 lakh or 5 lakh as the case may be, depending on whether the assessee is a normal individual or a senior citizen or a super senior citizen. If these conditions are satisfied, then how is partial integration done? We compute A. What is A? First, we compute tax on net agricultural income plus total income. Okay. So, for example, if net agricultural income is 5 lakh, and the total taxable income is say 10 lakh. Okay. And the basic exemption limit is say 2.5 lakh. Then A is what? Tax on net agricultural income plus total income. So we compute tax on 5 lakh plus 10 lakh. That means tax on 15 lakh. Then in B, what we do? We compute tax on net agricultural income plus basic exemption limit. So net agricultural income is 5 lakh. Basic exemption limit is 2.5 lakh. So in B, we compute tax on 7.5 lakh. And then what we do? We figure out the tax on total income, which is A minus B, So tax on 15 lakh minus tax on 7.5 lakh is actually the tax on total income. And as we discussed in the video on the rates of tax, we then need to reduce or deduct rebate under section 87A. We need to add surcharge as applicable, and then we need to add HEC at the rate of 4%. Which gives us the amount of tax liability. So this is the method for partial integration of agricultural income. We will now discuss the provisions of section 10AA, which contains special provisions in respect of newly established units in a special economic zone, SEZ. So section 10AA provides for a deduction. We need to note that it's not an exemption, it's a deduction which is provided by section 10AA. And it's provided in respect of profits derived from export by newly established units in SEZ. So it's an incentive to promote exports by newly established units in special economic zones. Who is the eligible assessee? Who is the assessee which is covered under section 10AA? So section 10AA benefit is provided to an assessee who begins to manufacture or produce any article or thing or provide any services in any special economic zone. So manufacture, production and provision of services, all these three are covered. And the assessee should begin to manufacture or produce or provide any services in SEZ during a specified period, which is from 1st April 2005 to 31st March 2020. This should be the period within which the SSE should begin the activity. Now you would remember that around the date of 31st March 2020, which was the last date for becoming eligible under Section 10AA, there was a breakdown of the coronavirus. And therefore, there were several SSEs who were not able to meet the deadline of 31st March 2020. So a relaxation was provided to them. And this timeline of 31st March 2020 was extended. So timeline has been extended to what? To 31st March 2021, one more year. But there is a condition. Provided the letter of approval under the SEZ Act has been issued on or before 31st March 2020. So while 31st March 2020 is the cutoff date, the SSE has been given one more year to begin the manufacture or production or provision of services. But the condition is that the letter of approval under the SEZ Act should have been issued to him on or before the original cutoff date of 31st March 2020. If that be the case, then the benefit of 10AA will be given. There are two basic conditions for grant of deduction. So deduction is to be allowed only when these conditions are fulfilled. And the idea behind these conditions is to ensure that the unit which is established is a new unit or a brand new unit. Number one, unit should not be formed by splitting up or reconstruction of a business already in existence. So an existing business should not be split up or reconstructed to form the new unit in SEZ. Number two, unit should not be formed by transfer to the new business of a second-hand plant and machinery. Of plant and machinery previously used for any purpose. So transfer of second-hand plant and machinery is not allowed. However, there is a relaxation which is provided up to 20% of the total value of plant and machinery. So up to 20% of total value of second-hand plant and machinery is allowed, but the rest, of course, should be newly acquired plant and machinery. So if these two basic conditions are satisfied, then deduction is allowed under Section 10AA. And what is the quantum of deduction? The deduction is allowed up to a total period of 15 years, beginning with the year in which the unit begins to manufacture, produce, or provide services in the special economic zone. Right? So for the first 5 years, so the year in which the unit begins manufacture, production, or provision of services, plus next 4 years, the first 5 years. Deduction is allowed to the extent of 100% of profits derived from exports. So export profits are eligible for deduction, and 100% of those profits is allowed as deduction in the first 5 years. For the next 5 years, the deduction is brought down from 100% to 50%. And the last leg of 5 years, in the total period of 15 years, the deduction allowed is the lower of 50% of such export profits, or the amount which is credited to a special economic zone reinvestment reserve account, or SEZ RRA. So one needs to open a special account, which is a kind of a reserve account where the amount is credited for, where the amount is supposed to be credited for the purpose of reinvestment into the same business. That is called SEZ RRA. So this is the objective, and therefore the lower of amount so credited or 50% of profits is allowed as a deduction. Now SEZ RRA should be used for two specific use cases. One, to acquire plant and machinery. And this should be first put to use within a period of 3 years post the year of creation of such reserve. So in the year in which the reserve is created, 3 years after that, that is the timeline for acquisition of plant and machinery and for putting it first to use. And until such acquisition, the amount so credited can be used but for the purposes of business of the SEZ undertaking. And therefore it cannot be used, say, for payment of dividend or for distributing profits or for remitting the profits outside India or for, say, acquiring any asset outside India. It should be used only for the purposes of business of undertaking. Now, if usage is not done in this particular manner, then deemed profits arise which are chargeable to tax. Deemed profits arise which are chargeable to tax. So if the amount which is credited to SEZRRA is utilized for a non-specified purpose, that means which is other than A or B, then the profits are deemed to be the profits in the year in which the amount is misutilized. So the amount which is misutilized is brought to tax. Similarly, if the amount is not utilized within the 3-year period which we discussed, then deemed profit arise and they are taxable in the year following such 3-year period. Now, as we noted above, the deduction under section 10AA is based on the quantum of profits derived from exports. So this is an important amount that needs to be computed. So first we need to calculate the profits of the business of the SEZ unit. The profits of business of the SEZ unit is supposed to be calculated, and then we need to apply a ratio to this profit. What is the ratio? The ratio is export turnover of SEZ unit to the total turnover of business carried on by the SEZ unit. So the profits of business is apportioned in the ratio of export turnover to total turnover. And we need to take into account the fact that all these amounts need to be computed in the context of SEZ unit alone, not in respect of other units or other businesses of the SSE. The SSE may have unit outside SEZ unit, which is a DTA unit, which is referred to as domestic tariff area unit. But for computing profits derived from export, we only need to take the amounts in the context of the SEZ unit. Now, what is export consideration? Export consideration is the consideration which is received on account of export and which is received or brought into India by the SSE. However, it doesn't include two items. Why? Because these two items, these two categories of amounts do not exactly represent the consideration received on account of export, and that's why if these amounts are included in export turnover, they need to be deducted. One, freight which is charged, telecommunication charges or insurance charges attributable to the delivery outside India. If this forms part, then it needs to be reduced. Secondly, expenses which are incurred in foreign exchange and rendering of services outside India, this also needs to be reduced. And since these items are reduced from export turnover, which is the numerator, logically these items should also be reduced from the total turnover of the business, which is the denominator in the formula. But if these two items are not included in the first place in the export turnover or total turnover, there is no need again to reduce such items further. There may be situations where a computer software is developed on site, which means that personnel may go outside India and they may be stationed out of the client premises or the client location in a foreign country, and the computer software may be developed there on site. Therefore, it may be difficult to say that there is an export of services because the software has itself been developed outside India. And therefore, the benefit of 10AA may be denied on account of such profits. But it is specifically provided, and this is a relaxation given, that profits from on-site development of computer software outside India is deemed to be profits derived from export, even though technically it may not be called as export, but it is deemed so, and therefore the benefit of section 10AA can be availed in respect of such profits. Now, how is deduction under section 10AA allowed? What is the mechanism? Note that it is not an exemption, it is a deduction. So it is to be allowed from the total income. Right? So first we compute total income, then deduction is to be allowed from the total income of the SSE computed under the Act before giving effect to this deduction. And deduction cannot exceed the amount of total income. So total income cannot become a negative total income on account of this deduction. We will now look at certain important exemptions specified under section 10. And we will only look at those exemptions which are important from an exam perspective. So under section 10.2, A member of HUF is entitled to exemption for any sum which has been paid out of the income of HUF. So if a person is the member of an HUF and he is paid any sum out of the income of HUF, then such sum is not taxable in the hands of such member of HUF under section 10(2). Similar is the position under section 10(2)(a) as far as a firm is concerned. So a partner of a firm is not taxable in respect of the share which he receives in the total income of the firm, which is determined according to the profit sharing ratio. So if the partner receives the share in the total income of the firm, such share is exempt in his hands under section 10(2)(a). But we need to note that only exemption is provided in respect of share in the total income. As far as interest, salary, bonus, commission, remuneration from the firm is concerned, it is taxable in the hands of the partner under the head PGBP to the extent it is allowed in the hands of the firm as a deduction. And as we know that firm includes an LLP, so this exemption applies to a partner of an LLP as well. Section 10(4)(2)(i) grants exemption to an individual in respect of interest income which is received from a non-resident external account, NRE account, in any bank in India, right? So if interest is received from such bank account in India by an individual, the interest income is exempt. However, the condition is that the individual should be resident outside India. Resident outside India, not as per Income Tax Act. This term is in the context of FEMA, Foreign Exchange Management Act 1999. Either this condition should be satisfied or the individual should be permitted by the Reserve Bank of India to maintain such account. In such case, such interest is exempt under section 10(4)(2)(i). Section 10(6) provides for different kind of exemption available to individuals who are not citizens of India, right? And one such exemption is under 10(6)(6). And this is called as, popularly, it's called as short stay exemption. And this is given to an individual who is not a citizen of India. Okay. Now exemption is in respect of remuneration. So this is the income which is earned. Remuneration, and it's received by an individual who is not a citizen of India, and it is received as an employee. And the individual is the employee of a foreign enterprise. So remuneration is received from the foreign enterprise as employee. And it is received for what? It is received for services rendered by such individual when during his stay in India. So such individual is an employee of a foreign enterprise and he comes to India, he is staying in India, and during his stay in India he renders certain services in respect of which he receives remuneration from the foreign enterprise. That remuneration is not taxable in the hands of such individual under section 10(6)(6). But there are three conditions to be satisfied. Number one, the foreign enterprise of which such individual is the employee should not be engaged in any trade or business in India, right? Second condition is that the stay should be a short stay. That's why the term short stay exemption. And short stay means that the stay in India should not exceed 90 days in the aggregate during the previous year. And number three, the remuneration which is received by such employee, which is supposed to be exempt, it should not also be deductible from the income of the employer. It should not be deductible from the income of the employer, which is chargeable under this act. In such case, the remuneration received by such individual is exempt from tax in India under section 10(6)(6), and this is popularly called short stay exemption. Under section 10(10)(b)(c), if an individual or his legal hire receives compensation on account of any disaster, then it is exempt, provided such compensation is received from the central government or a state government or a local authority, and the disaster is as defined under the Disaster Management Act. So if the disaster is covered under this act and if the compensation is received from these entities, then it is exempt in the hands of the individual or his legal hire in the unfortunate case of death of such individual. Section 1010D, any sum received under a life insurance policy is exempt in the hands of an individual, and we will look at this particular point shortly in some detail. Any payment from Sukanya Samriddhi account, whether it's in the nature of interest or accumulated balance, etc. So any payment which is received is exempt under section 1011A. Similarly, there is section 1016 and it provides exemption in respect of scholarship. So if any person receives any scholarship which is granted to meet the cost of education, right? So the scholarship is related to education, then it is exempt. The exemption is available irrespective of the amount, whether it's small or big, or the source of a scholarship, from whom it is being received, or the actual spend, whether the amount is spent or it is not spent. It doesn't matter, so long as the scholarship is granted to meet the cost of education, it is exempt under section 1016. And as far as member of a parliament or member of a legislative assembly, MP or MLA are concerned, and they receive daily allowance or constituency allowance, that is exempt under section 1017. Similarly, exemption is provided in respect of any award or reward, and the exemption is under section 1017A, but the condition is that the award or reward should be instituted or approved in public interest by the central government or state government. Section 1018 provides exemption to an employee of the central government or state government. So exemption to a government employee. What is exempt? Pension received by such person is exempt. And family pension received by any member of the family on death of the individual is also exempt. The condition is that such central government or state government employee should have been awarded a gallantry award like Paramveer Chakra, Mahavir Chakra, etc. So this employee should have been awarded a gallantry award, and in respect of that person, the pension is exempt, and in the unfortunate case of his or her death, the family pension received by the member of the family is also exempt. Exemption is provided to a Sikkimese individual. So Sikkim is a state in India. Exemption under section 1026 AAA. Two kinds of incomes are exempt. One, from any source in Sikkim. The source can be any source, from a house property, from transfer of a capital asset, from business, salary, etc. If the source is in Sikkim, the income is exempt if the individual is a Sikkimese individual. Second, dividend or interest on securities is also exempt. And the source need not be in Sikkim, it can be anywhere. So if the company is, say, based out of the state of Maharashtra, it is not based out of the state of Sikkim, it has its registered office in Maharashtra. And then dividend is received by a Sikkimese individual, even then, even though the source is not in Sikkim, the income will be exempt. However, there is a condition. The condition for exemption under this 1026 AAA is that the Sikkimese individual should not be a Sikkimese woman, who on or after 1st April 2008 marries a non-Sikkimese individual. The news is that very recently the Supreme Court has held this particular provision as ultra vires of the Constitution. It is discriminatory, and therefore the Supreme Court has struck down this provision. Therefore, even though it's in the statute books, it's part of the Income Tax Act, but it's not effective, it cannot be enforced. Lastly, section 1043. So any amount which is received by an individual as a loan in a reverse mortgage scheme. So an individual may enter into or avail a reverse mortgage scheme, right? And he may receive a loan, whether in lump sum or installment, and that loan is exempt under section 1043. We will discuss this in detail in the video on capital gains chapter. So as we noted above, section 1010D provides exemption in respect of any sum received under a life insurance policy, right? So when the policy matures, then the assessee receives a sum, and he may also receive a sum by way of bonus. This is also exempt. So section 1010D is the exemption section. The exemption depends on what? It depends on the nature of life insurance policy and whether the sum is received on death or otherwise. Okay. Now there can be three kinds of policies. First, a key man insurance policy. What is a key man insurance policy? Key man insurance policy is basically a life insurance policy taken by a person on the life of an employee, mostly a senior employee. By key man, we mean a person who is very important, right? Who is the key personnel. So generally, the businesses take life insurance policy or the key man insurance policy on the life of their senior most employees, right? Or it can also be taken on the life of a person connected in any manner with the business. So in case of a key man insurance policy, the sum received is taxable, whether it is received on death of the person or in any other case. So in all cases, the sum received under key man insurance policy is taxable. It's not exempt under section 1010D. Then comes a case of excess premium policy. Excess premium policy is a policy where the premium is being paid in excess. It's being paid beyond a certain level, right? In such case, if the sum is received on death, if the sum is received on death of the person, of the assured, then the sum is exempt under 1010D, right? Else, it is not exempt, it is taxable. In the case of any other policy, the sum is not taxable, the sum is exempt under section 1010D. So excess premium policy is a policy where the premium payable for any of the policy year, the premium payable for any of the policy year exceeds a prescribed percentage of what? Of the sum assured. So there is a threshold of premium which should be paid as a percentage of sum insured. And if the threshold exceeds for any of the policy year, the policy gets classified as an excess premium policy, and consequently any sum including bonus which is received on account of such policy is fully taxable. It is not exempt under section 1010D. So what we need to consider is the date of the issue of policy. When was the policy issued? If the policy was issued from 1st April 2003 to 31st March 2012, then the threshold is 20%. And if the premium payable for any of the policy year is more than 20% of the sum insured, more than 20% of sum assured, then the policy becomes an excess premium policy. And exemption under section 10D is not available in respect of such policy. 2. If the policy is issued during the financial year 2012-13, that means from 1st April 2012 to 31st March 2013, in such case, the threshold is reduced from 20% to 10%. So the premium payable for any of the policy year, if it is more than 10% of the minimum sum assured, then the policy becomes an excess premium policy. And what is the position on or after 1st April 2013? And this is the position for the current previous year as well, right? In such case, the threshold is 10%. So if the premium payable for any of the policy year exceeds 10% of minimum sum assured, then the policy year is an excess premium policy. However, this threshold of 10% is slightly increased to 15%, in which case, in case the insured is a person with disability or severe disability, which is referred under section 80U, or the insured is a person who suffers from a disease or ailment specified under section 80DDB. And we will talk about 80U and 80DDB in the video on deductions from the gross total income. In that case, the threshold is 15%. In other cases, the threshold of premium for any of the policy year is 10%. Now, if the policy is not exempt under section 1010D, the entire amount, the full amount which is received is taxable. The full amount which is received is taxable. And even if the premium payable exceeds the threshold for just one policy year, even then the entire proceeds are taxable. Even then the entire proceeds are taxable. The deduction from gross total income under section 80C is also available on account of life insurance premium paid. And there also we find a similar table where we have similar thresholds which have been provided. What we need to note is the difference. If the premium exceeds this particular threshold, For example, if the premium exceeds 10%, if the premium is more than 10% of sum assured, then deduction under 80C is allowed to the extent of 10% of such premium. The excess is ignored and deduction under section 80C is allowed. However, in such case, exemption under section 1010D is not at all allowed. The entire sum becomes taxable because the policy is then classified as an excess premium policy. So section 14A basically disallows any expenditure which is incurred in relation to exempt income. And it says that no deduction will be allowed in respect of expenditure incurred by the assessee in relation to exempt income. So if this is an exempt income and this is a taxable income, and exempt income is 100 and expenditure incurred is 20, taxable income is say 500, expenditure incurred is say 40, okay? So what will be the total income for the purpose of levy of tax? Will it be 500 minus 40, 460, or will it be 500 minus 40 minus 20, which is 440? Right? This of course is not taxable because it's exempt. So as per section 14A, the assessee will not be allowed deduction of this 20 rupees because it's incurred in relation to exempt income. So only 40 rupees will be allowed as deduction, and therefore 460 will be the total income on which tax will be levied. Now section 14A applies notwithstanding anything to the contrary contained in the act. So even if the expenditure is otherwise allowable as a deduction under the act, it's not supposed to be allowed by virtue of section 14A. Further, even if the income which is exempt, right, it has not accrued or arisen or it has not been received during the previous year. So expenditure has been incurred in relation to exempt income, but the assessee has not received the exempt income, or that income has not accrued or arisen in the first place, and the assessee claims that, look, there is no exempt income which I have received or which I have earned, and therefore entire expenditure should be allowed and no disallowance should be made. But the provision says that even if this is the case, then the deduction of expenditure shall not be allowed by virtue of section 14A. So this brings us to the end of this video. I hope things are clear to you. All the best and good luck.